Something unusual is happening in the Bitcoin market right now, and if you're watching this with me, you can probably feel it. The charts are not just falling, they are behaving in a way that suggests stress beneath the surface, the kind of stress that does not always appear in headlines until it is already too late. Prices that once seemed unstoppable, levels above $120,000 not so long ago, have dropped sharply. And what we are seeing is not just volatility. It is a shift in the rhythm of the market itself. And when the rhythm changes, experienced observers start paying very close attention. Over the past weeks, the signals have been coming in one by one, like cracks forming in glass before it finally breaks. Trading volumes have surged during downward moves. Funding rates in derivatives markets have flipped rapidly, and liquidation data shows that leverage positions have been unwound at a pace we have not seen in many months. These are not random fluctuations. They are the fingerprints of a system reducing risk quickly, almost abruptly. When leverage unwinds, prices do not drift lower, they drop. Sometimes violently, because positions that once amplified gains suddenly amplify losses. If you followed markets for years, you know this pattern is not unique to crypto. We saw similar dynamics during the 2018 volatility spike in equities, when leveraged exchange-traded products collapsed within days. We saw it during the liquidity shock of March 2020, when even U.S. Treasury markets briefly seized as investors rushed for cash. What is happening now shares the same underlying mechanism, the rapid removal of leverage from a financial system that had grown comfortable with risk. But here's the part that many people misunderstand. This decline has not been driven primarily by panic among small investors. The data suggests something more structural. Institutional flows, derivative positioning, and macroeconomic expectations have all shifted at the same time. And when large pools of capital reposition, the effects cascade across markets faster than most people realize. Look around the broader financial world with me for a moment. Interest rates remain a dominant force, shaping every asset class. Central banks have not fully returned to the ultra-loose conditions that fueled the previous bull cycle. Inflation pressures, even when easing, remain unpredictable. Bond yields continue to move in ways that tighten financial conditions globally, and Bitcoin, whether people like it or not, now reacts to these forces more than it did 5 or 10 years ago. It is no longer isolated from the macro environment. It is part of it. At the same time, liquidity, the lifeblood of all markets, has become less abundant. Global money supply growth has slowed compared to the extraordinary expansion that followed the pandemic era. When liquidity tightens, the first assets to feel the pressure are usually the most volatile ones. That is not a theory. It is a pattern repeated across decades, from emerging markets in the 1990s to technology stocks after the dot-com bubble. And yet, there is another layer to this story that you need to understand. Despite the sharp declines, volatility today is still lower than what we witnessed during the 2022 crypto bear market. That is a contradiction that many people find confusing. Prices are falling, confidence is shaken, but the underlying structure of the market appears more resilient than in previous crises. Exchanges are functioning. Major institutional products continue to operate. Large holders, at least for now, are not liquidating en masse in the way they once did. So what does that mean? It means we are looking at a market that is stressed but not broken, and that distinction is critical. There have also been events in recent days that remind us how fragile confidence can be. When even a single lending platform pauses withdrawals or faces liquidity concerns, it sends a signal through the entire ecosystem. It is not always about the size of the institution, it is about psychology. Markets move on perception as much as reality. Once participants begin to question the stability of counterparties, risk premiums rise everywhere, and capital becomes more cautious. Now, I want you to consider something that many commentators overlook. Bitcoin has spent more than a decade evolving from a fringe experiment into an asset watched by governments, pension funds, and multinational corporations. That transformation changes the nature of every correction. In the past, downturns were driven mostly by internal crypto dynamics. Today, they are intertwined with global capital flows, currency movements, and expectations about economic growth. We saw a similar transition in gold during the 1970s. Before that decade, gold was primarily a monetary reference point. But once it began trading freely and attracting large speculative flows, it started reacting to inflation data, interest rates, and geopolitical shocks. Bitcoin is undergoing a comparable transformation, and transformations are rarely smooth. And here is the contradiction that makes this moment so difficult to interpret. On one side, the long-term fundamentals that many investors point to. Limited supply, growing institutional awareness, and technological infrastructure remain intact. On the other side, the short-term forces of liquidity, leverage, and macro uncertainty are powerful enough to drive prices sharply lower, sometimes regardless of those fundamentals. So, when you hear people asking whether Bitcoin has reached the bottom, understand that the question itself may be misleading. Markets do not announce their bottoms. They form them slowly, often painfully, in environments where confidence is weak and narratives are confused. The bottom is not a moment, it is a process. What I can tell you, speaking from years of watching financial crises and recoveries, is that periods like this are when the true character of a market reveals itself. Not during the euphoric rallies, not during the headlines about record highs, but in the quiet, tense weeks when uncertainty dominates and every piece of data seems to carry disproportionate weight. Right now, we are in one of those weeks, and whether this turns out to be the floor beneath a new cycle or just another step in a deeper correction will depend on forces far larger than any single chart or headline. It will depend on liquidity, on global capital flows, on policy decisions made in rooms far from trading desks, and on the collective psychology of millions of participants who are all, in their own way, trying to answer the same question you are asking right now. I need you to stay with me for a moment, because what we are seeing now is not just a correction. It is the kind of environment where hidden weaknesses begin to surface. When markets fall quickly, the first thing that disappears is confidence. And once confidence starts to fade, pressure begins to travel through the system in ways most people cannot see in real time. You are not just watching a price move on a screen. You are watching liquidity tighten, leverage unwind, and risk tolerance evaporate across multiple layers of the financial world. Let me explain what that really means. For years, cheap money shaped the behavior of investors everywhere. When capital is abundant and borrowing costs are low, markets become comfortable with leverage. Traders borrow to amplify returns. Funds take larger positions. Companies expand more aggressively. But when financial conditions tighten, that entire structure begins to reverse. Positions must be reduced, loans must be repaid, and assets must be sold, not because people want to sell, but because they have to. This is exactly how crises often begin, not with panic, but with obligation. Forced selling is one of the most powerful downward forces in any market. We saw it during the Asian financial crisis in 1997, when currencies collapsed, not simply because investors lost faith, but because debts denominated in foreign currencies became impossible to service. We saw it again in 2008 when institutions sold anything they could to meet margin calls, even assets they believed in long term. The mechanism is always the same. Liquidity disappears faster than expected. And now you are seeing echoes of that mechanism inside the crypto ecosystem. Some lending platforms and financial intermediaries have already faced stress as prices declined. When a lender pauses withdrawals or struggles to meet obligations, it does more than affect its own users. It sends a signal through the entire network that counterparty risk still exists. That word, counterparty risk, is something many people in the early days of crypto believed they had escaped. But markets always find a way to reintroduce it. I want you to think about how fragile trust can be in financial systems. Banks do not collapse the moment they suffer losses. They collapse when people begin to doubt them. Markets do not crash simply because valuations are high. They crash when participants suddenly realize that everyone is relying on everyone else at the same time. That realization spreads quickly, and once it spreads, the pace of change accelerates. There is another pressure building beneath the surface that you should not ignore. The economics of mining have changed significantly since the halving reduced block rewards. On paper, reduced issuance should support prices over time, but in the short term, it can create stress for operators whose costs remain high. Electricity, infrastructure, and hardware financing do not become cheaper simply because rewards are smaller. Some miners must sell more of what they produce just to stay operational. And when many participants face the same reality simultaneously, the cumulative effect becomes visible in the market. At the same time, the broader macroeconomic backdrop is far from stable. Global growth forecasts remain uncertain. Interest rates, even when paused or adjusted, are still at levels that compete with risk assets. When investors can earn meaningful returns in safer instruments, the incentive to hold volatile assets weakens. This is not speculation. It is a principle that has governed capital flows for generations. The higher the risk-free rate, the harder it becomes for speculative assets to attract sustained inflows. You may also notice something else happening. Correlations between markets are rising again. Bitcoin is moving more in sync with equities, particularly technology stocks, than it did in earlier years. This tells us that large institutional participants are treating it as part of a broader risk portfolio. And when those participants reduce exposure, they often reduce exposure everywhere at once. That synchronized movement can amplify declines and create the impression that multiple markets are weakening simultaneously. But perhaps the most dangerous risk is psychological, and it is one that cannot be measured easily. Expectations shape markets as much as data does. When investors begin to believe that prices will fall further, they delay buying, they reduce exposure, and they hold more cash. That collective hesitation becomes self-reinforcing. The absence of buyers can push prices lower just as effectively as aggressive selling. We have seen this pattern throughout history. During the Great Depression, it was not a single event that deepened the downturn. It was a series of decisions driven by fear and uncertainty, each one rational in isolation, but devastating in combination. During the European debt crisis, markets did not collapse overnight. They eroded as confidence drained slowly, week after week, until policymakers intervened. Right now, the crypto market is navigating a similar environment, not identical but comparable in structure. Liquidity is thinner than it was during the peak of the bull cycle. Leverage is being reduced. Institutions are more cautious, and global economic signals remain mixed at best. And yet, here is where the situation becomes truly complex. Even as these risks accumulate, the system has not broken. Infrastructure continues to function. Trading continues. Large networks remain operational. That contradiction, the coexistence of stress and stability, is what makes this moment so difficult to interpret. It creates uncertainty. And uncertainty is the one condition markets struggle with more than anything else. So when you ask whether something worse could still happen, understand that the answer does not depend on a single indicator or a single event. It depends on the interaction of many forces: liquidity, leverage, macro policy, and human psychology. Markets are ecosystems, and ecosystems rarely change direction instantly. They shift gradually, sometimes invisibly, until the change becomes impossible to ignore. What you are witnessing right now is one of those transitions, and the reason I am speaking to you with urgency is not because I know exactly what will happen next. No one does, but because periods like this are when the greatest misunderstandings occur. People either underestimate the risks or overestimate them. They look for certainty in a system that is inherently uncertain. All I can tell you from years of studying financial cycles is that the most dangerous phase of any downturn is not always the first drop. It is the phase where everyone is trying to decide whether the worst is already behind them or still waiting ahead. I want you to take a breath with me for a moment, because in times like these it is very easy to see only the danger and forget that markets have always moved in cycles. When prices fall sharply, the narrative becomes dominated by fear, but history shows us that the same forces that drive declines often plant the seeds of recovery at the very same time. And if you are watching closely, some of those forces are already beginning to appear, even if they are quiet, even if they are easy to miss. One of the most powerful drivers in any financial market is scarcity. Not artificial scarcity created by sentiment, but structural scarcity built into the system itself. Bitcoin's supply is not flexible. It does not expand in response to demand the way fiat currencies do. And after each halving event, the rate of new issuance declines further. That mechanism does not push prices higher overnight, but it changes the long-term balance between supply and demand in a way that has historically mattered more than short-term headlines. You can see parallels to this in commodity markets. Think about oil in the early 2000s. Years of underinvestment in production capacity did not matter much when demand was weak, but once global growth accelerated, supply constraints pushed prices higher with surprising speed. Gold behaved similarly after the early 2000s recession, when central banks began expanding balance sheets and investors started searching for stores of value. The point is not that Bitcoin will follow the same path, but that scarcity, when combined with demand, has always been a powerful force. And demand, despite the volatility, has not disappeared. Large institutional structures, exchange-traded products, custodial platforms, and regulated trading venues continue to operate. This is a major difference from earlier cycles. 10 years ago, a severe correction could have crippled the infrastructure of the entire ecosystem. Today, the foundations are broader, deeper, and more interconnected with traditional finance. That does not eliminate risk, but it changes the nature of it. I want you to think about how markets behave after major structural shifts. After the financial crisis of 2008, equity markets did not recover immediately. They spent months moving sideways, testing investor patience, before beginning one of the longest bull markets in history. During that period, many people believed the recovery was fragile or temporary. But beneath the surface, liquidity was returning, balance sheets were stabilizing, and confidence was slowly rebuilding. Something similar can happen in any asset class. Recovery rarely begins with excitement. It begins quietly, with stabilization, with volatility decreasing, with selling pressure gradually fading. These are not dramatic signals. They are subtle, and that is why they are often overlooked. Another factor that could shape the coming months is monetary policy. Whether central banks tighten, pause, or eventually ease conditions has enormous influence on global liquidity. You have seen this before. When liquidity expands, capital searches for opportunity. When liquidity contracts, capital retreats to safety. These cycles do not just affect stocks or bonds. They affect every market that depends on investor flows. Bitcoin, like it or not, now belongs to that world. And there is something else that deserves your attention. Market psychology does not move in straight lines. Fear reaches extremes, and then, often unexpectedly, it begins to reverse. When everyone expects further declines, even small positive developments can shift sentiment dramatically. This is why some of the strongest rallies in history have begun in environments where the news still looked negative. Look back at March 2009, when equity markets reached their lows during the global financial crisis. Economic data was still deteriorating, unemployment was rising, banks were still fragile, yet prices began to climb because markets move ahead of the data, not behind it. They anticipate, sometimes months in advance, the direction of change. I am not telling you that such a turning point has arrived now. What I am telling you is that markets are forward-looking mechanisms. They react not only to what is happening, but to what participants believe will happen next. Expectations about future liquidity, future adoption, and future regulation all play roles that are impossible to quantify precisely, but impossible to ignore. You should also understand that the ecosystem surrounding Bitcoin is stronger than it once was. Infrastructure, custody solutions, regulatory frameworks in several major economies, and institutional participation have all expanded significantly over the past decade. These developments do not prevent downturns, but they can influence how deep and how prolonged those downturns become. And yet, here is the paradox that makes this moment so difficult to interpret. The same institutional participation that provides stability can also increase correlation with other markets. When global risk appetite declines, institutions reduce exposure broadly, and Bitcoin moves with them. This dual nature, strength and vulnerability existing together, is one of the defining characteristics of this phase. So as you watch these markets with me, understand that recovery, if it comes, will not announce itself with a trumpet. It will begin quietly in the background with subtle shifts in liquidity, sentiment, and positioning. It will look uncertain, fragile, and easy to dismiss. That is how recoveries almost always begin. And this is why I keep telling you to pay attention not only to price, but to structure. Watch how markets behave during declines. Watch how quickly they recover after sharp drops. Watch whether selling pressure accelerates or begins to fade. These are the signals that experienced observers focus on, not the daily noise. Because in the end, the story of any market is never just about the fall. It is about what survives the fall, what adapts, and what emerges stronger on the other side. And right now, whether you realize it or not, that process is already unfolding in front of you. Now, we arrive at the question that everyone is asking, the question that echoes through every trading desk, every forum, every late-night conversation between investors staring at their screens. Has the market already reached its bottom, or are we only halfway through the storm? I want you to understand something very clearly as you listen to me. In real time, bottoms never feel like bottoms. They feel like uncertainty, like exhaustion, like a strange silence after weeks or months of noise. That silence is often mistaken for stability, and sometimes it is, but sometimes it is only the calm between waves. If you have studied financial history as long as I have, you begin to recognize certain patterns. Markets rarely collapse in a straight line, and they rarely recover in one decisive move. Instead, they grind, they move sideways, they produce false rallies and sudden drops. This is what technicians call consolidation, but behind that technical word lies something very human: hesitation. Buyers hesitate, sellers hesitate, capital waits. And waiting is one of the most difficult psychological environments any market participant can endure. Think back to the aftermath of the dot-com crash. The Nasdaq did not simply fall and then recover. It spent years moving through cycles of hope and disappointment as investors tried to determine which companies would survive and which would disappear. Or think about the period after the global financial crisis. Even after the initial panic ended, confidence returned slowly, almost reluctantly. Markets needed time to rebuild trust, and trust, once broken, never returns instantly. What we are witnessing now shares elements of those periods. Liquidity conditions remain uncertain. Global growth forecasts are mixed. Interest rates, though no longer rising aggressively, are still high enough to influence capital allocation. When investors can earn steady returns in safer instruments, risk assets must compete harder for attention. That is not a temporary phenomenon. It is a structural reality of modern financial markets. At the same time, there are signs that the most extreme pressures may already be easing. Leverage has been reduced significantly compared with earlier phases of the cycle. Forced liquidations, while still occurring, are less violent than they were during the initial waves of selling. Volatility, though elevated, is not at the extreme levels seen in past crises. These are not guarantees of stability, but they are signals that the system is absorbing stress rather than collapsing under it. And this is where the situation becomes truly complex. Markets are not machines that respond to a single variable. They are living systems influenced by policy decisions, technological developments, geopolitical events, and human psychology all at once. A change in central bank communication, a shift in global liquidity, or a sudden geopolitical shock can alter the trajectory of markets within days or even hours. That is why certainty is so dangerous. The moment someone claims to know exactly where the bottom is, they have already misunderstood how markets function. You should also consider how much Bitcoin itself has changed. A decade ago, it was largely isolated from traditional finance. Today, it is embedded within it. Institutional investors, derivatives markets, regulated products, and global capital flows all play roles in determining price. This integration brings both strength and vulnerability. It provides deeper liquidity and broader participation, but it also means Bitcoin now reacts to the same macroeconomic forces that drive equities, bonds, and commodities. We have seen this before in other markets. Gold, once primarily a monetary metal, became increasingly sensitive to interest rates and currency movements as financialization expanded. Oil markets, once driven mainly by physical supply and demand, became influenced by futures trading and global capital flows. When an asset becomes part of the global financial system, it gains legitimacy, but it also inherits the system's instability. And this brings us back to the central question: has Bitcoin reached the bottom? The honest answer is that no one can know in real time. What we can observe are conditions, trends, and probabilities. We can see whether liquidity is improving or deteriorating, whether selling pressure is accelerating or fading, whether confidence is returning or continuing to erode. These signals do not provide certainty, but they provide context, and context is what experienced observers rely on. There is also a deeper perspective I want you to keep in mind. Markets are not only mechanisms for pricing assets, they are mechanisms for processing information. Every trade reflects a judgment about the future. When prices fall sharply, it means the collective judgment of millions of participants has shifted. But that judgment is never permanent. It evolves as new information emerges, as expectations change, and as time passes. And here is the part that many people overlook. The most important developments in financial systems often occur quietly, during periods when public attention is focused elsewhere. Infrastructure improves, regulations evolve, institutions refine their strategies, technologies mature. These changes do not make headlines every day, but over years, they reshape entire markets. So as you sit here listening to me, watching these charts, feeling the tension in the air, remember that you are witnessing more than a correction. You are witnessing a transition from one phase of the market cycle to another, from one structure of participation to another, from one set of assumptions to another. These transitions are rarely comfortable. They are uncertain, sometimes chaotic, and often misunderstood in the moment. What matters now is not predicting the exact day or the exact price of a bottom. What matters is understanding the forces at work, recognizing the patterns of history, and keeping a clear view of the larger picture. Because in the end, markets are shaped not by a single event, but by the accumulation of many small changes, each one almost invisible until, suddenly, the direction becomes clear. And when that clarity finally arrives, when the noise fades and the trend reveals itself, most people will look back and say the signs were there all along. The truth is, the signs are always there. The challenge is learning to see them while the storm is still unfolding.